Hello friends, welcome. Friends, if you recall, on 29th May, the rating agency, on 29th May, this is the date, the rating agency S&P Global, so this is S&P Global, they made an announcement saying that India's outlook revised to positive on robust growth and rising quality of government spend, right? So they're reiterating the BBA A3 rating. BBA is the long term, BBA minus, BBB minus, and then oblique A3. Triple B minus is the long term rating and A3 is the short term rating. And they are reaffirming those ratings, and they have revised the outlook to positive from stable. Now, this is a very important event, and why this is important is because the rating of a country decides its default risk. Now, default risk is an important metric which is considered by the investors for making investment, and it also impacts our interest payment outflows, because if you have a higher default risk, then more premium is going to be charged on loans, and then the equity premium is also going to be high. So your valuation of the companies who are doing business in India is going to go down, because your cost of capital is going to increase, and when you discount using the higher default risk, your valuation is going to go down. I am not going to get into those valuation details, etc. But today's video is something completely different. And what I am going to focus in this video is one very, very important thing. I'm not going to go into the details of this press release, because it will make no sense for me to do that. Anybody who is interested in this discussion can read this press release, and I'm going to put a link in the description. What I am going to focus on is what is the S&P's prediction as far as India's debt to GDP percentage, because that is the key metric to talk about, and rest are all details. So if you look at what the S&P is saying, and this is basically the starting year is 2018. So only look at this particular line to make it very simple, debt to GDP. This is the line. And here you will notice that the starting year is 2018. And then as you progress, the end year is 2027, because this is a long document and you can't see which is the start year and the end year. Therefore, I'm just putting the numbers so as to make it very simple. So what our debt to GDP was in the starting year, which was 2018, was 71.5%, which includes the central government debt as well as the state government debt. And it progressively increased, and it became as high as 90.8%. And then now it is in the downward trend. Now what S&P is predicting is that by 2027 we will be able to meet this number of 80.8%, and this is very, very crucial, because this will impact a lot of things and which India has to do in order to meet this debt to GDP number, and today we are going to talk only about that. And it is going to be a very heavy presentation with a lot of numbers, so be with me, otherwise we will get lost together. So just be with me and be patient in this presentation, and you will find it very interesting. So let's do the following. Before I take you through the numbers, I would like to basically point to this presentation which I did around 6 months back, where there was a warning which was given by IMF that there is a huge problem as far as India's growing debt crisis is concerned. And this video explains why IMF said that India is facing a huge debt crisis, and you can go through those numbers. So I'm going to just leave it like that. But let's go into the details of this video. For that, I am going to use the following sheet. And this you will find in the in the web page of Ministry of Economic Affairs. Again, I'm going to post a link and where you can basically go and get this data. Now I'm going to just blow this a little bit so that you can see the numbers. Now, if you look at this page, you will notice that this page consists of the total debt here and then the breakup of the debt, which is central government debt. We are only talking about central government debt. We are not talking about the state government debt. Now, as per this report, which was just recently published, the data was recently published, Indian central government has a public debt of around 156 lakh crores. This is the number. And the external debt around 10 lakh crores, which is 9.78 lakh crores. And then if you break this, because these two numbers, if you add, this is going to give you the total debt, which is 173 lakh crores, which is roughly around 174 lakh crores. And now the public debt is broken down into two debt. One is the internal debt, another is the other liabilities. And then you can go into the details of how there are various items, the internal debt items are broken down into various subcomponents which are here. Right, and we will visit this and we'll talk about this as we move forward in this presentation, and I'll come back to and explain what are the implications of this. But let's go into the let me just get back and bring my screen back to normal zoom. Let's now look at this particular dashboard. Now here is a very important number which we have to take into consideration. Again, we are talking about the combined liabilities of center and state as a percent of GDP. Now, if you recall what S&P said, S&P number, if you look at this number, he's talking about a number which increased from 71.5 from the year 2018 and went high, and then he's expecting this number to go down to 80.8% by 2027. And that is the reason I am basically showing you this particular dashboard. If you see, we said that the S&P has started calling out the number from 2018. Now it may be taking calendar year, we are taking financial year. I don't know, I have not seen this with so much, but it doesn't matter. So let's forget about whether they are taking calendar year and we are taking financial year. The numbers matches. You see, it started with 70%, roughly around 70%, and then it shot up to 90%. See, the number matches, and then we are at FY24, this number is 83.35. Now this number consists of the total debt, which includes the central government debt as well as the state government debt, right? Because if you see here, the combined domestic liability of central state here, and then on top of which, if you are adding the external liability of the center, you are going to get this number. So this number is very, very crucial, and note this number. And if I take you through the absolute numbers also will match. And if you look at the absolute number in this particular table, you will see the absolute number is 246.2 lakh crores, which is the combined center and state liability. Now the central liability is how much? The central liability, the number I showed you, which is 173.3, right? Now let's look at the number again in the sheet. In the sheet, if I just zoom it a little bit, and you will see the number will show up right in front of you, which is 173.98. See this number? 173.98. The same number is here. So let's go again into that sheet. So if you see this, no, not this sheet, this one, and I'm going to zoom back, and if you see this 173.3. Now on this we are adding the liability of the state, and then we are getting this number 246.2, and that brings the debt to GDP number to this number of 83.35, right? So you are with me till now, right? So it's very important. Now let's go into our Government of India's account statement. Now this account statement is going to tell the story that where the Government of India has to pull the plug in order to get this number low, the debt to GDP number, because it can't afford to get the debt to GDP number go up, because that will impact its rating, international rating, and in the process there are many bad things are going to happen going forward. So there will be a lot of constraint the government of India will have to deal with their expenses and even the capex expenditure, including subsidies and interest payments. Let's look at those numbers, then only you will be able to understand where we stand, and that will give you a very good overview as to what is going to come in the forthcoming budget of this government, the new government, which is going to be announced very soon. And that is the reason I'm doing this video, so that you understand the constraint. Everything is anchored around that 80% debt to GDP number by 2027. That's where the government will like to go, because the government wants the country's rating to be improved, so that we are seen as a good investment hub, and our outflows from the point of view of interest payments, etc., will be reduced, because people will be seeking less risk premium on the investment, because they will find investing in India less risky. Okay, so that's the whole point. Now, if you look at this, you will find this particular sheet is the Government of India's account statement cumulative. Now, what does it mean? It is again in the financial year time scale, and we have the data till FY25, and this is giving you the budgetary estimate. Now, this is a very busy dashboard. Forget about the dashboard. Just put your eyes very close to the mouse where I am basically taking you through. Now you look at this particular number, which is 16.85 lakh crores, which is the fiscal deficit number. This is the crucial part. Now look at this number. This number rose to 18.49 lakh crores in absolute terms, then reduced to 15.91 lakh crores, then it went up to 17.55 lakh crores, then 17.35 lakh crores. These are all budgetary estimate, and the earlier budgetary estimate, which the previous government before the elections, they said that it will be 16.85 lakh crores. Now this is crucial. Why this is crucial? Because our total expenditure, which is 47.66 lakh crores of the budgetary estimate, this is the total expenditure we are making, and this expenditure is contributing to this fiscal deficit, because our total earnings as far as revenue income is concerned from tax received and non-debt received is only 30.8 lakh crores. So we are making a revenue received, which is basically revenue from tax, and then we have non-debt revenues, then the total revenue is around, total receipt, not revenue, total receipt is around 30.8 lakh crores, and then our expenditure, the total expenditure is 47.66 lakh crores. So when you subtract this 47.66 lakh crores from 30.8 lakh crores, you get this fiscal deficit number. Now, what does it mean? What is the meaning of this? The meaning is that you will have to cap this number, 47.66 lakh crores. You have to reduce it or make it stable. You can't increase this number beyond a certain threshold, because as soon as this 47.66 lakh crore number increases beyond a certain threshold, the fiscal deficit number is going to increase, and you need to carry more debt. And as you carry more debt, your debt to GDP is going to go up. And this applies to not only the central government but also in the state government. So what is the issue? The issue is that we are making lot of development and non-development expenditure. Development expenditures are expenditure which actually leads to development work, like capital expenditure, like investment in education, human capital. There are a lot of expenses that we need to make which are development in nature, and there are some non-development expenditures which are like interest payment. Now look at this interest payment, and you will be surprised to see that interest payment is increasing exponentially. Look at this, 5.31, 5.88 lakh crores in FY19. Now, in the budget of FY25, we have estimated an interest payment of 11.9 lakh crores. Now, this interest payment is emanating from what? This is, by the way, central government. This is emanating from this particular number, which we already spoke about. This is the number. Where was the number? This number. okay, so let me just go to the absolute number. So if I go here in the absolute number, this is the number, right? Look at this number, 173.3 lakh crores, this number. This is the number. So if you see 173.3 lakh crores, this number. Now this number might have in some non-interest bearing loans as well. Like if you look at in this particular sheet, you will find that when you go into the breakup, and if I take you through, I'll zoom it, you will find that there are some non-interest bearing debt also, but those are marginal. Mostly it is interest bearing. And if you do the calculation, 1.73 lakh crores, and let's say let me just take you through the let me just zoom out, and let's go to the sheet here. This is the sheet, and if you see this 11.9 lakh crores. So if I divide this 11.9 lakh crores, let me just bring it here. Just a minute. Let me just take this a little bit higher here, and then I'll do this calculation here. So if I do just a minute. Let me go again here, and I do this calculation. 11.9 lakh crores, which is the budgetary estimate, divided by 173. Let's assume it is 174. We are making an interest payment roughly around 6.8%. Right? That's how the number is coming. So we are making a interest payment in that particular manner, and that is why this number is going on increasing. Because more debt you are carrying, more higher the interest payment, the more difficult it becomes for you to manage this number of interest payment, which is a non-development expenditure. Now, why it actually creates a lot of problem? Because it creates a problem. Why? Because your number, this number is fixed, 30.8, which is the receipt that you are making on account of tax payment, etc. These are fixed. Right, revenue you are making on tax collection. So there are capital receipt, there are tax receipt, and the overall receipt is fixed. You can't basically disproportionately increase this number. So you are eating away a very sizable amount, 11.9 lakh crores from this number. So in order to bridge this for development expenditure, if your non-development expenditure is high, then you will have to increase your fiscal deficit. So imagine the kind of constraint the government will have on certain things which it is forced to make because of political consideration. Let's look at those things which the government of India has to make on political consideration. And what are those? Subsidies. Very, very important subsidies. Because if you look at the subsidies, and this is what? Lakh crores. The subsidy increased in FY21 to 7.58 lakh crore. This is again central government, right? And then in FY22, the number went down to 5.04 lakh crores. FY23, again the number increased to 5.62 lakh crores. And FY24, the number is being projected down to 4.03 lakh crores. Now what you are seeing here? You are seeing that the government of India, instead of increasing subsidies, they are bringing down the subsidies. So now if the government is going to bring down subsidies, what is going to happen to various subsidy schemes like PLI, like the farm subsidies, petroleum subsidies, fertilizer subsidies, and various other subsidies which the government of India talks about, and we keep on making this point that we need to basically give all those procurement. We have to basically announce for the farmers a procurement policy so that the farmers are able to get properly compensated for those their produces. So that is nothing but a subsidy, right? LPG subsidies. So all these subsidies have to go down, and there will be huge amount of pressure and fight between the various departments as to who should be getting the subsidies. Government does not have the luxury to give away subsidies just like that. Now let's look at the number from the point of view of percentage of GDP, because that will give you a very good idea. Now if you look at the number, because absolute number does not tell the story. Now the subsidy numbers, if you see as a percentage of GDP, which is a sizable amount, and we look at both the non-development expenditure the interest payment as well as the subsidies, you will find that the subsidy was around 2.49, around 2, and it was going down. It was steadily going down, and it went down to 1.18% of the GDP till FY19, and then it started increasing. You see, it started increasing. Now the government is trying to bring it down to the level what it was in FY18, 19 and 20. So there is a huge pressure. There is no luxury. However, interest payments, you see, 3.13% of the GDP, 3.15% of the GDP, 3.32% of the GDP, FY15, and then by FY20, the interest payment actually went down. Why it went down? Let's ask this question. I think those viewers who are actually, looking at this with seriousness probably will know that why the interest payments as a percent of GDP went down, because the government drove down the RBI short-term repo rates. When it drove down the RBI short-term repo rates, what happened? The debt, the maximum debt the government of India carries, a sizable amount, not maximum, a sizable amount of debt the India is on treasury bills. And those treasury bills and short-term debt, you end up paying lower interest rates. And that is why I said I'm going to come back to this chart again. And if you see here, you will find that if I again zoom in, and you will see that there are treasury bills here. See, this is a treasury bill, right? 91-day treasury bill. Then we have got 14-day treasury bill. Then 182-day treasury bill. 354-day treasury bills. So if you add all these things, and then security on small saving. So it is not just long-term loans the government of India is taking. Government of India is also taking a lot of short-term loans, and those short-term loans are leading to interest payment obligations, and those interest payment obligations are driven by the RBI repo rate. Higher the repo rate, more the interest payment obligation, and that is why you see that this number, the subsidy number, the interest payment number actually went down to 3.5% by FY 2020, and then suddenly it rose. Now it is continuously in rising trajectory, and that is why the RBI is so much worried about bringing the interest rates down. Because if the interest rates are down, it actually gives two impetus to the economy. The first is that it reduces the government interest payment obligation. It gives more money in the powers of the people, and they can basically take cheaper loans. And the process, the economy can get some kind of fillip from the point of view of making more investments. But there is a negative side also. It kind of drives inflation, which is a very important thing which the government has to take into consideration. So controlling the interest rates is not in the hand of the RBI all the time. If they can't contain inflation, they can't bring the interest rates down. So this is a very important point to note, that subsidies and the interest payment. Now let's look at the development expenditures, the development part of the expenditure. Now you see here the capital expenditure was around 1.58, 1.82, 1.84% of GDP. Till FY20 it was around 1.67% of the GDP, and then suddenly after FY20 it shot up, and it has now become 3.39% of the GDP, and government continues to drive this up, because this is a development expenditure which is being looked at sharply by the rating agencies like S&P to increase our country's rating. So this is a very important fact which we have to take into consideration before we go into the making allocations for various segments of our budgetary allocations. Because if we are going to make our allocations in a very irrational way, then our debt carrying capacity has to increase, and that is going to have a huge impact on our country's rating going forward, as well as it will destabilize country from the point of view of higher interest payment obligation. Now let's look at, this is again percentage of GDP, and it is the overall country's GDP. This is state governments, right? State governments interest payment, because I am going to focus on non-development expenditures, which is a very important part, interest payment. Now if you see, the state government also makes a sizable interest payment because of the deficit it has to finance. Now this number was roughly around 1.5% of the GDP till FY16, and then it is going up. It went in FY21, it became around 2% of the GDP. Now it is being driven down, and they are trying to drive it down, and therefore the state government does not also have the luxury to carry more debt, because more debt means more interest payment. And therefore there are certain non-development expenditures like I'll tell you that, for example, if you see the non-development expenditure interest payment, then administrative services also, see, non-development of state government, this is also showing a rising trend. And then the pension state government, it is also kind of showing a rising trend, right? So there are a lot of pressure, and therefore the development expenditure, if you see the development expenditure, it was around 9.76% of the GDP in FY12. Now the number was increasing. It increased till FY17. The number shot up to 12% of the GDP, and then it actually went down, and now it is actually has been maintained at 12% of the GDP. Now if you are able to push this number to higher value of the GDP, then your ability to make investments, fruitful investment, which will result in further positive feedback on the growth of our country, will be better, will be looked at by the rating agencies in a positive manner, which will help our country going forward. Right, so that's the state part, and then let's look at the market borrowing. So if you look at the market borrowing for both central government as well as state, and again let me do percentage to GDP, because that gives a very good picture rather than absolute value. So if I do a market borrowing of central government as well as state government on a percent of GDP, you will see that the combined gross borrowing in FY24 as a percent of GDP is 8.63%, right? So this is the number, 8.63%. Now this number actually in the initial stage was around 8.69%, then it went down, and then it increased, to a very high value because of the lower base of GDP. And in FY22 and FY23 the number also was high because a lot of subsidies were given, and now they are trying to bring it down. And going forward this number has to go down, because more market borrowing you make at this rate of interest, you are basically locking yourself on a larger interest payment obligation going forward. Now, there are certain other structural things which the government of India is trying to do, which I'm going to talk about in this chart, and then we are going to close this discussion because it is already 27 minutes. Now, if you look at what are the options before the government of India to manage this huge debt which the government of India has. Because as debt increases, one thing which you have to understand, that repayment of debt is not accounted in the budget. The budget only takes into consideration interest payments. It does not take into consideration that the debt as it comes for repayment. It does not. Because the debt is always circle backed. Because as you repay new debt, the old debt, you have to take new debt. So it is basically cyclic in nature. You have to keep taking debt. And interest payments are taken into consideration in the budget for as far as allocations are concerned. It is not that debt payment principles are never taken into consideration in the budget. Now, in order for the government to restructure, because when the old debt comes for repayment, what do? You have to make some structural changes in order to ensure that you are able to repay those debt. What you do, you drive those maturity period of the current debt in future. Look at this weighted average maturity period of the debt. These in the initial stages in FY12 etc., the maturity period was around 12 to 15 years, then it went to 14.56 years, then 13 years, then 16.21 years, then 14.94, the 17.85, and now it is shooting up to higher number of years. Now it is like 21 years. Now as you go forward in time, you will see that the government is pushing its debt obligation into the future. Is it good? Is it bad? We have to see. Time will tell. Because the perception is that India's economy is going to grow pushing this obligation in future, it shouldn't be a problem, because we will be able to service this debt, right, as our economy grows, because the interest payment obligation shouldn't be a problem, and it will become a smaller percentage of GDP. Now, this is based on a huge assumption. What is the assumption? The India's GDP will perpetually grow, and we will not see systemic events which will pull down the GDP. There could be events like COVID, there could be world wars, there could be something else, which can pull down the GDP. So, in order for India to prevent those systemic to insure against those systemic shocks, we have to be a country which is resilient enough. Now, one positive thing of our country is our external debt is a very small component of our internal debt. Now, if you look at this particular chart, you will see that external debt is just 10 lakh crores, right? And internal debt is 1.56 lakh crores. So, therefore, because our external debt is a very small component of our internal debt, we have a better leverage, because we can manage internal debt better. We can print more money, we can push the inflation slightly higher, so that to make those debt which were taken earlier, devalue those debt, etc. Those things can be done. But while you do so, when you suppose, let's say, if you are not able to repay those debt and you have to devalue those debt by printing more money and driving inflation high, you will create discontent in the country. People will be up against you, because once the inflation goes high and the money devalues, in order for you to devalue the principal part of the debt, the public is not going to take it easy. But it is going to be a control situation than having huge obligation to pay debt internationally where you cannot default. There is no way you can default, because there could be many bad things which can happen to your country, because our BOP is dependent upon, our current account deficit is dependent upon positive sentiment and international investment in the stock market, foreign investment, as well as in FDI, because our trade deficit is not very good. We are having a negative balance of payment on account of trade, right? So, if India is seen as a country which is defaulting, then people will not make investment, and we'll have a huge BOP crisis. So anyway, friends, so I will like to stop here. I just wanted to give you a flavor as to what kind of problems that we are going to face, and what kind of constraint the government is going to work in this budget. Please don't think that it is going to be a cakewalk, because government will have to balance this very, very delicately to bring down the debt to GDP to the level of 80% by 2027. If they don't, then India is going to face a huge problem as far as rating is concerned. We want better rating, because we don't want to pay unnecessary interest. We want more investment in our country, and that's very, very going to be very crucial. And one more important thing is, now since India's bonds are getting listed outside the country, the bonds are going to get evaluated in the market on a daily basis. So your default risk, which was getting hidden and it was to be extrapolated by other parameters, will be clearly visible in the bond market. You will be able to measure your default risk, which is going to impact your cost of capital. So friends, I think this video went very long, and I really didn't want to make this video long, but there was so much data to talk about, so I thought let it go. So I hope that you probably like this video, and I'll come back to you with a new video next time. Thank you very much.